Bank profits are high, but not apparently high enough to keep all their workers. ANZ will axe 1,000 jobs in the next 4 months. That's on top of the 560 jobs going from Westpac. The cuts came as the Commonwealth and National Australia Bank joined the Big Four push to hike interest rates, even though the official cash rate is on hold. It's not popular, but is it justifiable? Greg Hoy reports.
In a time of record profits, ANZ's announcement that it's axing 1,000 staff further fuelled the fat cat furor surrounding the Big Four banks.
You know, Morty.
Yes?
They say bank fees are money for nothing. It's not money for nothing. It's money for us.
These aren't rich people. These are ordinary workers making $40,000, struggling to make ends meet. These aren't the rich fat cats who make the decisions and profit from these decisions. These are just hard-working, everyday Australians who will get told today that their bank that makes a $5 billion profit can't afford to keep them. It is a complete and utter nonsense.
Many Australians are going to be frustrated not so much by the banks making record profits, but by what they perceive as unfair actions and treatment. And that's why we're seeing such a big backlash towards the big banks as they're making these decisions.
Despite securing a remuneration package of around $10 million last year, the head of ANZ, Mike Smith, wasn't around today. It was Australian CEO Philip Chronican who had to face the music with the media.
We're doing this because we think Australia needs healthy, profitable banks who can continue to lend and support the Australian economy. That profitability is under threat, and we're doing what we think are the prudent things to manage this company properly for that environment.
The timing is hardly impeccable, not only because the banks did bank about $25 billion in profits last year, but as the flak flew over the ANZ's sensitive announcement today. The Commonwealth Bank, by sheer coincidence of course, raised its mortgage rates by 10 basis points, 2 days before it's expected to announce a record first-half profit of around $3.5 billion. The NAB also raised its rates. Little wonder the Federal Treasurer has been doing his war dance of late, but it's not just the banks who think they're being badly portrayed.
I find his comments a little bit disingenuous at the time. Yeah, they're profitable, and they are the most profitable in the world, but the same could be said of all sorts of industries in Australia which aren't particularly affected by the GFC.
The fact is, our major banks are very, very profitable. Their net interest margins are back to where they were prior to the global financial crisis. So give your customers a break.
Australia's banks are in kind of an interesting position. They've grown much faster than the rest of the world for the past few years, and they've been able to hold those jobs for as long as they can. They've made really good efforts to try and make sure that people have stayed employed, but the global financial crisis which has swept through the world has really kind of finally caught up with them. So they've got to find a way to lower their costs as quickly and as practically as possible.
We've seen with business growth slowing, with margins compressed, we were having much lower rates of revenue growth. Indeed, revenues are pretty flat, and in that environment we have to manage our costs. So as regrettable as it is, the announcement we've made today is about managing our costs.
The NAB used to boast it had broken up with the big boys of banking, but seemed to rejoin the club today in lifting its standard variable rate, despite the Reserve Bank last week keeping the official cash rate on hold. Bendigo Bank also lifted its rate, signalling a brave new world in banking in Australia.
The interest rates are going to be really responsive to the cost of funding now. It feels like that they've unbundle themselves by the RBA, which would also be hurting the Treasurer fundamentally. The RBA is no longer in charge of interest rates in Australia. It's the cost of funding, which means that it's the international forces are at work in Australia's residential home loan rates now, so the government control is somewhat lessened on that.
I think we're in a very interesting new cycle where the major banks are going to move outside the RBA and perhaps a little more regularly in terms of increasing rates in this difficult funding environment. I hope that we see them moving to decrease rates as well when those opportunities arise.
It's no consolation for those set to lose their jobs. But when it comes to rate rises, not everyone agrees the public is powerless to do something. Australia's credit unions and building societies say there is a very simple solution at hand.
There's no doubt that this is a difficult funding environment for all banking organisations, but mutuals, that is the credit unions, the building societies, the mutual banks, we're already about 0.5% below the banks before they've started to shift their rates up. If we can do that off a smaller base, we really question why it's necessary for the major banks to bring this kind of pain to their customers.
Well, given the interest rate rises and the job cuts, we have asked the heads of Australia's major banks onto this program to discuss it, and we await their arrival at some stage, hopefully soon. Greg Hoy with that report.